And the third point that I have on this slide is that I hope everybody has a separate business checking account. I would take that a step further and suggest that you also keep a separate business credit card. That way you're not commingling personal household charges with business charges. And this becomes important, as many of you may remember from yesterday, that our credit card interest and finance charges are deductible on Schedule C to the extent they relate to our business expenses. Now, that's harder to pare out when the credit card is commingled, but it is worth keeping it separate. And also, if you do carry a balance and incur some charges, those charges are deductible as a Schedule C expense. This slide, I myself have this conversation every quarter. Most of my clients say the same thing. Where is my money going? I write the check for my tax bill and I feel like I'm not left with anything. And that's because it's a little bit true. Depending on your income level, you may be in a marginal tax bracket of 24. It could quickly jump up to 32%. Our self-employed tax rate that we have, there's no way to get out of being a self-employed business owner, is 15.3%. And that's our employer and employee share of essentially FICA and FUTA, Medicare and Social Security. Now, we do get a deduction for half of that, which is calculated within the system and within the software. And then, so now we're at 40%. And with California, if your income is somewhere around 150 all the way up to, I think the range is 275. I could be wrong on that. You could say California is at a 9% tax rate. Now we're just over 50%. And this is why you want to capture all deductions that are allowed, track everything. I've had a lot of people say, well, just use my mileage same as last year. Well, that actually, you might be missing a deduction. And I know it is time intensive to keep track of a lot of those things, but you want to deduct everything that you're entitled to deduct because you don't want to pay, and I don't want anybody to pay more money to the IRS than they have to. So I mentioned a SEP IRA, and as a self-employed person, this is one of the biggest single deductions that we get. And what we're doing is we're paying ourselves. And if you think about who writes law, the people sitting in Congress, while they are paid a salary for their job in Congress, they almost always have consulting jobs that they're doing on the side. So the Retirement Code section, Chapter 400 of the IRC, is all about retirement, and it is actually one of the biggest chapters in the tax code. So taking advantage of retirement, we have more benefits than someone on a W-2. Their retirement is capped at $19,500. We can retire, we can contribute up to $56,000 a year, that adjusts annually for inflation, into our own retirement account for a tax deduction. That SEP IRA is calculated at either 25% of your net Schedule C up to a max of $56,000. There are other plans I don't know if you've ever heard your colleagues talk about a DB plan, defined benefit, where you can actually contribute 100% of your net Schedule C profit into a retirement plan. I don't know many folks that can do that and still have cash to afford their regular monthly lifestyle. But that is a really good option to front load retirement if that is something that you can afford and something you can plan for. The third point here I bring up is that you can own rental real estate in a self-directed IRA. And we trust real estate. It doesn't evaporate. If the market dips, there's still real property there that the tenants can hopefully are still there paying rent. But an IRA can hold real estate. It can buy and sell real estate. Just like any other retirement account, it is completely separate. So you're never going to commingle the asset. If you have plans for buying an investment property for a family member one day, this is not the place to do that. But it is a way to diversify your retirement account and kind of, mitigate the risk that maybe the market goes down, but there's still real property that you have in a retirement account. The last point here, I'm not going to go into detail, but a health savings account, an HSA, is a great plan. It's a great account to pair with your health insurance. So when it comes around open enrollment at the end of this year, October, November, December, remember that Andrea said, look at an HSA as a really good option. It may make sense for you for your health, but it's also a very good option as it has a tax deductible contribution, tax-free distribution to reimburse yourself for health expenses. And then when you reach retirement age, it essentially converts to an IRA. So now you're getting more money into retirement, which most of us years from now are never going to kick ourselves and say, well, gosh, I wish I hadn't put as much money into my retirement account as I did. So remember HSA when open enrollment comes out. And with the SEP IRA, I hope everybody is already taking advantage of that, or your accountant is asking you every year, how much money do you want to put into your SEP? If you're not, start building that into your budget. You can look back historically and see your net Schedule C to determine how much, 25% roughly, you can put into a SEP, and start setting aside a few hundred or a few $1,000s a month toward your SEP contributions. I think I answered a question yesterday, actually, that you don't have to wait until the end of the year to fund it. You can fund your SEP as you go and know that there will always be a true up to the allowable maximum. But that takes advantage of market conditions. And also, if you're interested in investing and looking at dollar cost averaging, you get your money in evenly throughout the year instead of one big transfer, in October.
I have one question on this right now, and we have actually a couple. The first one is, you mentioned that there's a $56,000 that you can deposit into a SEP IRA. Is there an age limit on when you can do that up to?
No, and actually an age limit works actually maybe backwards than what you're thinking. Is there's a catch-up contribution. There are catch-up provisions allowed in the entire retirement section. And forgive me for not remembering which is which. Some are at 50, some are at 55. But with IRAs, 401ks, and SEP IRAs, there's an additional 1,000 or 7,000, depending on the account type, where you can actually contribute more, because the intention is that you want to pay into your retirement so that you do have that cushion and benefit from the tax-free growth.
Okay,
I hope that answered your question.
Sort of. I mean, I got a better understanding, but just for clarity, is there a certain age up to that you can continue to make these $56,000 deductions? Like, if I become 75, can I still make those $56,000 deductions, or is that limited to people under 70?
You can continue to contribute, but most clients that I've seen, it just not in my practice, but at the firm, it doesn't become as important necessarily, maybe because hopefully in retirement your income has gone down because you are drawing from retirement accounts. You may not be as active in your business, so the need for a tax deductible retirement contribution isn't as meaningful. But it's not prevented. You're not excluded from doing that, but it almost, I have seen very rarely where people continue into retirement to contribute to retirement.
Thank you. I think that answers the question.
Okay, great.
Yeah, that $56,000 depended on the income, though.
It is the greater of 25% of net Schedule C or 56,000, whichever is. Did I say that backwards? It is the lower of 25% of your net Schedule C or 56,000 is the cap. So if you're interested in contributing more, a plan such as a DV plan would be more beneficial. And 56,000, that's about a $200,000 net Schedule C. So that's net of expenses.
All right.
Well, I will move on. The next slide, for any of you who remember yesterday, I certainly don't mean for you to, read this and take notes on this, but just to jog your memory and refresh your memory and go, oh yes, I can deduct, I mentioned credit card interest. If you have a team and you are going to dinner and inevitably you're going to talk about business, if you are out with a friend or a referral source, if you're talking about business, if you are spending any money with the intention of getting your name, your brand, your recognition out there, generating referrals, generating business meal with a client, it is a deduction. So that was more meal specific. Hopefully everyone else is already accounting for these expenses when they put their expenses together for their return. Let's see, something I put at the bottom here I didn't mention yesterday. The last comment here about renting your home for entertaining. If you have a holiday open house or if you have a summer client appreciation, let's say you shopped around and looked at local restaurants, and to rent a banquet room is going to be $1,500, minimum. You can actually rent your home, your backyard from yourself. This requires some more documentation. You definitely have to make sure you keep really good records of what you would be paying if you went off-site. But this is something that it's a little bit of an aggressive strategy, but it is allowed. And it's referred to as the Augusta rule because that's a tax case that brought it up and it was defended. So think about how that might work for you if you're comfortable doing something like that. I'm comfortable signing off on that and filing a return as long as my client has things very well documented, and it can't be egregious. It's not going to be something every weekend. But this is something that, I imagine many of you do host events, client appreciation things. Maybe keep this in the back of your mind as after shelter in place is lifted, as this becomes an option. The next slide, don't have to run through the numbers with a calculator, but I'll explain the columns. The status quo column is without any retirement contributions, which is what I'm calling the discretionary column. So we have a spouse who is a W-2 earner and a self-employed agent with a Schedule C. So the total net tax due in gray at the bottom of almost $67,000, that's before withholding and payments, any quarterly estimates, but that's the liability. The second column, the discretionary column, is if you fully take advantage of retirement available to you and the impact, you can see the net change. So if the spouse makes their maximum 401k contribution of $19,500, if you as the agent fully maximize your SEP IRA, which at $200,000 is almost $38,000 of SEP IRA contribution, if this family has an HSA account in place, a health savings account, they get a $7,100 tax deduction for funding that account. Now that is a lot of cash outflow. That's $64,000 of outflow, but you're paying yourself. All of those accounts are your own accounts. They're going to get a tax deduction when you make the contribution. They benefit from tax-deferred growth on earnings. And what that does is it avoids almost $21,000 of tax. Now, this may take some time to budget in and build this up if it's not already built into your budget, but you can see how meaningful the savings is when you fully take advantage of the deductions that are available to us. Let's see, I just saw a notification. Is there a chat that I should pop over to?
Well, I just wanted to remind you, Andrea, that you're down to about 5 minutes.
Oh, my, okay.
A number of slides still to go.
Yeah.
I'm not sure we're going to have time for all of that, but if you could kind of wrap it up here in the next 5 minutes, that would be great.
Sure, thank you so much. All right, and continue to chime in with questions, and I will do my best to keep going. Right now, and this is really related to COVID and shelter in place, I myself personally also feel a tendency to keep my cash. I really actually had to talk myself into making my own SEP IRA contribution because things feel uncertain, and we think, oh, what if we need it? But looking at your overall cash flow, looking at your tax position, looking at what your comfort is with the market, it might still make sense to fully fund your SEP and your retirement contributions because the market is down. So keep this in mind. If you have investment advisors, start a conversation with them. I have the deadlines on here for a traditional, a Roth IRA, or an HSA. Those contribution deadlines remain July 15th. That's the extended COVID deadline. And October 15th is still the extended deadline to fund our SEP IRA. So more COVID-related planning, PPP payroll protection program. There's a lot of alphabet soup here, but as self-employed people, we qualify. These are net schedules.
Andrea, again, your audio is going in and out. So I'm not sure if we have time to fix that and also cover payroll productions, our payroll protection plans that you were talking about next. So what I'm going to do here is I'm going to ask anybody if you have any questions. Right now would be a good time to put them in the chat box or raise your hand. There's a lot of things that Andrea could tell you about regarding the payroll protection plan and all of these things. And if you were at yesterday's meeting in the North Valley, she went over this extensively. And the only hand I see raised right now is Jaime. Go ahead, Jaime.
I just want to say, I totally forgot about the business credit card I have. And all these years I've been under the assumption that, hey, they took that away from us a long time ago. And here I am hanging on to this one business card, corporate card, and all this time I just haven't taken advantage of it. I could probably go back and re-amend previous ones. I'm not sure if that's worth it, but going forward, I'm gonna make sure before July 15th, I'm gonna do this one for sure. Thanks for the reminder. Just a comment.
You're welcome. Yeah, well, hopefully you can hear me better. More than likely, it's not a material number. It may cost them the same amount.
Sorry.
Okay.
There is, just shake your head if I'm correct. There is the opportunity to go ahead and amend previous returns and account for that if in fact it's substantial enough. And somebody like yourself can help us do that if we needed it. Is there any other question that we could ask Andrea while we sort out this? Seeing no hands raised, I apologize for having to cut you off there at the end. Andrea, we're missing out on, it looks like we're missing out on about 7 or so of your slides. We'll have to have you back so we can hear the rest of your talk. And just a reminder that the Guild Mortgage is going to have you do their lunch and learn. Not exactly sure when that is going to be, but it should be available by contacting Jeff at Guild Mortgage. Or, Andrea, if you would put your contact information into the chat box. That way people will have a chance to also get a hold of you if they can't wait to get their understanding of the PPE and the EIDI, all that stuff that we're getting from the COVID stuff. Again, I thank you very much for your participation on this.
So you can email to me, Ilana, investor@gmail.com, if you have questions about taxations, about taxes.
Thank you guys. Sorry.